Thank you. Good morning, everyone. Thank you, Margot, for the lovely invitation. Thank you, Gunther, Walter as well, who helped invite me. I don't know if Gunther is around. I haven't seen him. Ah, good. Yeah. So it's a fantastic opportunity to be here speaking to you. You know, I have a tendency to try to rationalize things in my mind. And a few years ago, I rationalized Stanford to myself. And I thought, Stanford is this place where anything is possible. and if you get a number of intellectually capable people, hardworking people, to believe they are in a place where anything is possible, that is a very powerful thing to do. And so to me, it's a pleasure, it's a privilege to be contributing to this conference today. And you know, in preparing for the conference, in doing some homework, I looked at the previous speakers and the previous schedules for the other previous two conferences, and I realized that I'm the first financial industry speaker in this conference. And so I'm going to spend a little bit of time taking you through what we do as investment managers that we are and a bit about our firm. But I have a feeling that there's a reason why there haven't been many financial industry speakers. It's because if you take us back to that percentage that Margot was talking about, the percentage of women in the industry, I'll bet with you the financial industry is right at the bottom. It's going to be small single digits, I suspect. And so, you know, that's something to change. And hopefully, in today's talk, you'll get a feeling for what we do and how you can make a difference in data science in this industry. And so I also realized that a lot of the speakers here come from industry giants like Google, Facebook, Intel, Microsoft. I work for an industry that is new to the conference, the financial industry, and for a much smaller company. So I'm going to spend a couple minutes taking you through who I work for and what I do for a living. So as you can see from the program, I represent a firm called Systematica Investments. We are an alternative asset manager, and we have been in charge of funds, systematic strategies, investment funds that go back to 2004. And so we have a long track record. I'm saying we are an alternative investment manager. There's more to come on that in a minute. But basically, out of the pool of people out there that manage assets, that manage money for other people, the alternative slice of that industry is the state-of-the-art, the very advanced piece of the industry. We are allowed to trade very liberally, a lot of different instruments. We trade in and out of securities very rapidly, the turnover is very high. We deploy a lot of leverage. And so we are somewhat the leading edge of the investment management industry. We have about $9 billion under management in our firm. And we are quite small in terms of staff. We employ 108 people across 5 locations worldwide. But we are diverse. Across these 108 people, we have 26 nationalities. So that is something to be proud of. Many of us have PhDs in science and engineering. I'm personally a PhD in engineering, and I was an academic for several years before I joined the financial industry in the early 90s. There's a little bit of a picture there just to put some faces to the name. So that's who we are. And we, in our mission statement, we openly talk about employing science and technology to achieve returns in investment management. Now then I thought, you know, this is a data conference. Let the data speak, right? So I actually computed the word cloud on 3 staff questions, 3 questions that we posed to staff. What do we do for a living? And you can see the word cloud there. We make money for clients. Pretty good. So this is a 98% participation by staff, by the way. So this is a good word cloud. Why do you work for Systematica? Well, clearly the environment plays a big part, and the culture and the team. And finally, describe the culture of Systematica. And I'm very surprised by this, but the word family comes up. And the culture and excellence, which is a value of our company. So that's who we are. So that's Systematica. So we are an alternative asset manager. As I say, there's going to be a little more about this. And I'm going to talk about systematic investment management. So first of all, let's take a step back to think about what investment management is. So investment management is the professional administration of various securities and other assets to achieve specified return goals, specified investment goals for clients. So what do? We deploy the capitals of the world, right? And where do these capitals come from? Well, there's a lot of big pools of money out there that need to be managed. You start with pension funds, so all of our pension money needs to be managed. If you think about insurance companies are in the business of collecting premium and stashing up the money in preparation for the need to pay out upon certain events. And so this money that the insurance companies put aside needs to be managed. Sovereign wealth funds hold the wealth of various countries, and they need to be managed. And so each one of these clients will have different preferences for time horizon, commitments that they have against those monies that they need managed. So some investors have a longer time horizon than others. Some investors need a lot of return. Some investors have restrictions on what they can and cannot invest. And our job is then to organize the portfolios that suit these investment objectives, and we do that through funds. We set up funds, and investors then come and invest in funds. So that's what the investment management industry does. There's about $80 trillion of professionally managed money worldwide. $80 trillion. And how is this pie split? So as I say to you, the majority of this money is managed in a fairly direct and straightforward way. So much of this money is deployed in buying stock markets. I just buy the stock markets and I hope that they will grant me the return that I need. Or I buy a portfolio of treasuries, of government bonds, and I hope that that'll give me the return that I need. The alternative asset management, the alternative slice of the investment management pie is about 10% of that 80 trillion. So 80 trillion is the big pie. 10% of the 80 trillion, about 8 trillion, is called alternative asset management. And then within the alternative slice, there are three parts. There's real estate and infrastructure, private equity, and hedge funds. So real estate, infrastructure, private equity, hedge funds. Systematica lives in the third of the 8 trillion, 10% that is called hedge funds. And as I say, we are the state of the art. We are the more innovative part of asset management. We trade in and out of things with little restriction. We deploy leverage. We have the freedom to innovate. And so the activity itself, in terms of how we deal technically with the activity, there are two avenues of work. One is what we call signal generation, and the other one is portfolio construction. So every asset manager will talk to you about signal generation and portfolio construction. Signal generation is the process whereby we decide which securities or which assets we have a view on. This is a good buy, this is a good sell, this is going to go up, this is going to go down. And so that is the forecasting part of the job. Then the portfolio construction is, once I've selected a number of securities that I'm interested in trading and having positions in, then how do I size those positions? How much of each? And how quickly do I go in and out of them? And that is the bit of the exercise where we really say, well, wait a minute, what kind of parameters am I working to here? What kind of risk does my client require, and what kind of time horizon does the client have? So that's what we do, and the game is, in terms of data science, the systematic approach to investment management is the one that is really applied data science, right? And because we live in a world where all decision making is becoming data driven, the press has really become very interested in systematic asset management. And 10 years ago, 15 years ago, when I joined this side of the industry, you wouldn't see any press on systematic trading. Nowadays, you see it all the time. There's headlines all the time. Now, if you actually look historically, the big famous investors in the world behave like data scientists. I don't know if you care to listen to what Warren Buffett had to say. I mean, Warren Buffett is perhaps an early time data scientist. He's a disciplined man who looks at the data to make his decisions and uses the data and monitors the data to support his ongoing decisions. So I think there is a lot of press there, but people are accepting systematic trading as a strategy. Now, what is it that stops systematic trading becoming more widespread and more dominant? I think there's some amount of algorithm aversion. So what I'm saying is I'm going to get to how we go about dealing with data and the challenges that we face. But before that, just to put it in context, I'm just telling you, look, it's a very good approach. We look at data to make our investment decisions, but there's a lot of algorithm aversion to fight against, to battle with. So some of the things that we hear are, I like systematic, but systematic funds, they tend to be all the same. Well, I cannot really understand the strategies. It's all rocket science. It's black box stuff. It's less transparent than discretionary trading. And then you have to think discretionary trading is the part of investment managers where the investment process is dominated by human decision making without the formality of data science necessarily. And so, one of the slides that I've got here is just to say, what does the data say? So if I'm here defending the data science-driven approach to investment management, is that a superior approach? Is that an inferior approach? How does that compare to the history of asset management, which up to now has been predominantly discretionary? And so this is a study, I'm quoting a study by a set of peers in the industry that computed the returns of over 9,000 hedge funds from one of the key industry databases, the hedge fund research database. And those returns span the period, an almost 20-year-long period between 1996 and 2014. And you can see the results there. What these guys did was they picked up the 9,000 funds and they used some natural language processing algorithm to classify them as discretionary or systematic using the description given in the database. And then they computed averages and some statistics on it. And you can see that they ended up with 4 groups: systematic macro funds, discretionary macro funds, systematic equity, and discretionary equity. And you can see that the returns, the average return, and this is excess return, this is a return over the risk-free rate. The average return is similar across all 4 categories. And then another exercise that they did was to try to explain these returns using common factors. And common factors have to be securities or types of portfolios that are easy, that are obvious, that are easy to deploy. And so they did a bit of analysis on that, a bit of regression there, to try to explain how much, to assess how much of the returns of each category could be explained by simple factors. And again, then what you're left with, once you've explained some of the returns using the simple factors, we're going to call alpha, we're going to call skill. We're going to say, look, this is really what these funds have delivered. And so there's an alpha row there. And by the time you've accounted for the easy to explain piece of the returns look even more similar. And then finally, if you normalize by the return volatility, so how much risk did I take in stomaching those returns, then the ratio at the bottom is quite comparable. So what is this slide actually here to say? The slide is here just to give you the message that the systematic approach to investment management is about the same, maybe a little bit better than the discretionary approach. So there's a lot of future promise in this approach. And so you say, okay, so Leda, you tell me that you work for this company, it's state-of-the-art investment management, you're about deploying the pools of capital of the world, and you tell me that up to now the world has been predominantly doing that job in a discretionary manner by opinions and by people looking at data perhaps in a less objective way. So what is the difference then? What is the difference between this systematic investment management approach and the more traditional discretionary approach? Well, this graph is about this difference. And the first thing that I need to say is that this difference is going away. The 2 approaches are merging. And in future, everybody will talk about the systematic approach because the discretionary guys have realized that they are at an information disadvantage. So they're trying to join us and integrate their world with ours. But in any case, historically, this is the main difference, the level of diversification. So if you listed all the trading opportunities in order of trade conviction, the discretionary guys tend to trade to the right of us systematic folk. So that means that they have fewer trades on and higher conviction on their trading. We, by contrast, have lots of trades on and not so much conviction on each trade that we have. And that is the main difference. Now, what is the implication of that? this is a highly science-oriented forum here, so I don't need to explain this to you, but I can tell you that most people out there don't think about these things. I used to ask this question to motivate the thinking about diversification. I used to say to people, listen, if I tell you that you're going to toss a coin for your life, and if you get heads, you survive. If you get tails, you die. And I offer you one throw on a very highly biased coin towards heads, because actually I'm nice and I want you to live. Or I offer you a truckload of throws on a less biased coin. Which one do you take? And most people take the highly biased coin, but that's not the answer. You guys are technical, you know that. So the game here is this. How biased does the coin have to be towards heads to achieve a positive outcome, to achieve on average more heads than tails, say with 80% probability? And the answer is if you have a lot of throws of that coin, then you only need a little bit of bias, right? Because you've got central limit working for you. So that is the game that we play. The systematic crowd tends to have a more diverse set of trades on, and we don't focus quite so much on getting each trade right. So in other words, by diversifying the choice of trade opportunity, the systematic approach makes the investment process less reliant on the random nature of forecasting and more reliant on the risk control and the portfolio construction. Okay, that's the key insight. Now, having said that, if you think about investment management, the glamorous part of investment management is forecasting. Huh? This is what gets people the headlines. Like if you call a market right, if you call a big event, that is what is glamorous about it. But our approach is very robust and very scalable and very auditable as well. Okay, so having said that, you're now pretty sold on the idea that systematic trading is very good, it's very auditable, it's a great approach, and it's going to grow to be the majority of the assets under management out there. Then let me get a bit more practical about what we actually do on a day-to-day basis. So in terms of signal generation, that's the forecasting problem, right? So there we're trying to look for factors that might tell us if a particular company or a currency or the stock market of a particular country is going to do better or worse in the future. So we're trying to forecast. What do? We look at all sorts of data. Price and volume data are key. We always start with price and volume. We perform a lot of regressions, various flavors of regressions. Natural language processing is a great discipline for us because it enables us to parse data in unformatted ways, so news and events and company filings and general press material. Occasionally we work in the frequency domain to try to assess signal generation. And then at the portfolio construction side of things, what do we do there? There, once you've decided which securities you have a view on, how much of each one do you want to own? How are you going to construct that portfolio? What are some of the techniques there? We use volatility estimation techniques. The problem of portfolio construction is a constrained optimization problem, so we deploy all the techniques there. We do a lot of matrix manipulation because you could think of the stock market as this multidimensional world described by all the stocks in your traded universe. And then there's another problem that we all deal with as well, which is the problem of executing the trade. So once you've decided you need to buy this many shares, then how do you go about buying them so that you don't move the market and you achieve good execution prices? And I'll take you through that in a minute. So let's get concrete now, and let me take you through some examples. So execution algorithms. So this is an area where data science really rules. And I think execution algorithms were the early part of data science in investment management, because everybody likes automated execution. Everybody likes algorithmic execution. In particular, the regulators feel very comfortable with it because they can check how things are being done, and we have a very direct way to monitor our participation in the market. So there's a slide there just to talk a little bit about how you can go about executing a trade throughout the day. So if you've got 1,000 shares to buy, you can do what we call a VWAP execution, a volume-weighted average price execution. And so what you do then is you take a little slice of every bit of volume that goes throughout the day, and you try to complete your transaction while staying in parallel with the volume traded. And so View App is a very safe and no-brainer way to execute, but it doesn't really optimize any advantage you might have of the information of intraday behavior. So what do? We study intraday volume trends. We try to establish whether volumes are higher in the morning, if there's seasonality in the day, and you try to time your flows to take advantage of that intraday seasonality. We also look at the order book information, and the order book is this great big list of people who want to buy and to sell. And so there's a bunch of people who want to buy, and each one is prepared to buy at a certain price, and a bunch of people that are prepared to sell. Each one is prepared to sell at a certain price. Analyzing the dynamics of that order book, like how many people do I have in each side, and do I have a lot of people wanting to sell and not a lot of people wanting to buy? And are the people wanting to buy very spread out in price? Are they arriving faster into the order book chat room than the people that want to sell? All that is very useful information about the price dynamics of the day. And we use all that as short-term signals for execution. So that's execution. Then a couple of comments on how big data can be used for investment. Here, this is just a slide to highlight the fact that when it comes to exotic data provision, there is a dynamic in the marketplace whereby the first level processing of all this exotic data is typically done by a small company, and there's a lot of startups in that field. So people that will deal with processing imagery on shopping mall car park activity, or the shadows of reservoirs of oil or of gas to extract information. We don't tend to do that first pass information. We tend to buy that pre-processed data. But there's a lot of small companies doing that, and we interact with them all. And so, a couple of examples of how we can use big data in investment. So suppose I have the following investment thesis. Large stock moves are legitimate when backed up by professional participation. And they are ephemeral, they're bound to disappear if they're backed up by retail participation. So that's the thesis, right? And so I can then assess every time a stock moves up by a lot or down by a lot, I can ask myself, is that a legitimate move, or is that a move that will disappear and I should bet against it? Well, one way to evaluate that is to look at the activity on professional and retail interfaces. And so we tend to buy that data. We buy it from technology companies. Some of it we process ourselves, some of it we buy, and we do post-processing of that data. But trying to assess whether the retail has been active entails, for example, monitoring a number of Wikipedia pages and all the mapping that goes with that. If you're interested in Apple stock, which Wikipedia page are you likely to look at? Well, there's several that will relate to Apple stock. And so all that data mapping and relationships between data needs to be addressed. And so this is just a chart of an investment return. The scale is not really relevant, but this is just showing that applying this investment thesis using some exotic data to assess the level of professional activity versus the level of retail activity does work. That does produce a gaining strategy. Then another example, classification and grouping of companies. There's lots of phenomena out there that stock markets do display that have to do with groups of companies. In particular, certain groups of companies tend to move together. And if a particular company deviates from the group, the price action tends to be of mean reversion to the group, the pack again. And traditionally, you look at sector classifications to group these companies. Sector classifications are somewhat limited, apart from anything, because given a sector, a company either belongs or doesn't belong. And so an innovative way to do sector classification is to do natural language processing on text-based information, news or company filings, and group the companies according to how they describe themselves or how they are spoken about. And so again, this is a chart. The scale is not very relevant, but this is just showing the same signal applied on a traditional company grouping and an alternative company grouping, and you can see that the performance improves. So systematic trading, use of big data, execution algorithms, enhancing investment signals using exotic data. The other question that I often get is artificial intelligence. How is that changing the landscape? And then again, the dream there is that of autonomous investing, right? Everybody thinks that, with the learning algorithms, I can throw all the data at the algorithms and the algorithms will tell me how to make money. Well, unfortunately, the biggest crime, the biggest sin of systematic trading is overfitting. And a lot of these learning algorithms are very, very rich models. They're very rich in parameters and in structure. The financial data is, by contrast, quite sparse and limited. And if you think about financial stocks, there's maybe 4,000, 5,000 investable stocks to a certain size, and you get one price point per day in a daily time series. You might get a tick level time series of prices, but that investment horizon is quite tight, not quite so easy to profit from. And so the idea that you can throw the data at an algorithm and the algorithm will manage money for you is still very far. I think the more likely scenario is these scenarios that I've described, where an investment thesis is derived from economic observation, and then we look at the data to enrich the expression of that investment thesis and to make it work. And then finally, I wanted to talk to you about ESG investing, and I hope I can leave you with a good message on this. I mean, ESG is a big topic. It's coming to everybody's mindset. ESG stands for environment, social, and governance considerations in investment. And more and more, people are becoming aware that how they deploy their monies, which companies they invest in, sends a message about what they think is sustainable, what they think is right, what they think is proper governance. In particular, the UN has published years ago their global goals. And from the UN's global goals, the principles for responsible investing came out. Systematica is a signatory to the UN PRI. And what do we do in that matter? Several things that we do. So, for example, in the terms of screening, so that's the first step of ESG investment, is to say, look, I am an investor, I want you to build a portfolio for me, but I don't want you to include stocks that do certain things. I don't want you to include tobacco, or I don't want you to include gambling stocks in the mix. So then what we can do with the systematic approach is we can actually rebalance the portfolio to compensate for those exclusions. And we can perform the exclusions on a systematic basis. Then in terms of alpha generation, the practice of finding companies that behave well, that have good governance, should give you some alpha sources. And then finally, impact. So can you let the companies know that you're investing more in them because they have good ESG practices? And so then, perhaps the most important slide of this presentation, I was watching some of Margot's videos about the conference, and she was saying something that Maria said this morning as well, that you want to join the data science community and make a difference because so many important decisions are being made on a data-driven basis. So there's $80 trillion of professionally managed assets in the world. Diversity plays a big part in that. You need to be at that table. And I just wanted to quote for you a statistic that I found, that in 2015, following the Paris climate meeting, the 2 years that followed the Paris climate meeting saw a 55% annualized growth rate in assets deployed under a sustainable mandate. So now we have a lot of diversity coming to the fore through ESG investment and through disclosure rules from the various regulators. So what is that going to do to the investment landscape? And then finally, a couple final slides, something to say in this forum. If you're contemplating a career in investment management, if you like data science, exotic data, and looking for investment management, it would appear that the data supports a good track record for women. So the database providers that do analysis on female-run funds report an outperformance. I have to say the sample is quite small and the time scale is short, but it's a positive, but it's a positive message anyway. And then finally, just to close, I just want you to go home remembering that systematic investment management is data science applied to investment. Think of Warren Buffett as a data scientist from now on. And this approach is at least on a par with the human approach, but perhaps more scalable and more disciplined. There's a large element of randomness in markets, relatively sparse data, so learning algorithms have limited use. You have to really watch out for overfitting. Overfitting is a big risk. $80+ trillion of managed assets globally, so this bit of data science has a lot of power. If you want to change the world, you've got $80 trillion there to change the world with. And ESG investing is the future, so let's try to join forces in shaping it. And that's what I had.
We have just 2 minutes or so for some questions. So while you're thinking about a question, let me start it off. First of all, I just wanted to say I love that statistic on women outperforming men, because it just shows you how fungible data is, right? I mean, you can always put it in the way that benefits you the most.
That is
have
true.
you thought about high frequency trading, or you have any thoughts on that? It's very popular right now.
So we do high frequency trading in the context of executing trades. So if you decide that you need us to buy 1,000 shares, then going to market entails looking at tick level data. We've had some success of neural nets in that application, but limited so far. The problem with high frequency trading is the capacity. So $80 trillion is a very large amount of money. I mean, institutional investors have very large tickets, and the horizon for investment needs to be longer.
Right. Makes sense. Okay, question. Yeah.
Thank you for the talk. I really enjoyed it. I have a question. Do you feel like a business insight or a financial background are prerequisite in your area, or you feel the data science part is more of a heavy lifting compared to the business insight itself?
I don't see you. Can you raise your hand? There. Good. So look, I'm an engineer by background. I was never particularly interested in financial markets. You know, I'll be honest about it. I was an academic. You know, I had my position and I was teaching away and doing research. I think, you know, as part of the job, of course, you do become aware, but you know, you as a good professional, you want to understand the environment that you're in. And so I've done plenty of studying of, you know, macroeconomics and news and other bits that affect markets. But in answer to your question, if I'm anything to go by, then no. You know, I think a passion for data science and an interest in making a difference. Again, I think, you know, there's something to think about is this. Look, you know, if you want to change the world, park your money in the right places. And if you think about investment management as this activity whereby the pools of capital of the world get directed, gosh, that is so powerful. And if that is going to become completely data-driven over time, then you can't miss that opportunity. You've got to join in and have your say.
Great. Well, thanks very much, Leda.